Matt, talk to the difference between brokers, mortgage bankers, and any other options that people looking for a loan might go to.
Okay. I would say predominantly the main differences between a mortgage banker and a mortgage broker is the banker obviously operates under different regulated guidelines than the broker, but the banker actually pulls the money from the deposits at the bank. So they, in a sense, derive their own loans, and a lot of the times they will not only fund their loans, but they'll service them as well. So they can do some things that brokerages can't, and vice versa, brokerages can do some things that mortgage bankers can't. A broker has the options of looking into multiple different institutions that will loan the money, finding what program fits best. Sometimes it does yield a little bit lower interest rate, which can be beneficial to the borrower, but we take the money from a different institution and then we fund the loans, whereas the bankers take it from in-house and fund loans.
We hear this word warehousing.
Mm-hmm.
Could you explain the concept behind warehousing?
Of course. We are a warehouse lender, and what that means is we have a set line of credit per month between my office and our other two offices. We have a brother and sister office as well. And basically what it means is we do enough volume. And when I mean volume, we're talking 30 plus loans a month. And we have to hit a certain dollar amount per month to keep the line of credit open. But basically we have $20 million per month allocated towards our purchases. So we process all of our loans, and then at the point of us being ready to fund, we have the options of funding these loans, very similar to a mortgage banker, in-house at closing. So it kind of streamlines the process a little bit better. It's a little quicker. And then once the loans close, let's say we did a $100,000 loan for the sake of the conversation, and we had, $1 million left on the line, then obviously we'd have $900,000 at that point. Every Tuesday, our loans get purchased off the line of credit by groups of investors, and then our line reestablishes itself over time.
Okay, great. We talk in the class about FHA, VA, and conventional.
Of course.
Say something about the differences in those loans.
Okay. VA and FHA are obviously government-based products. FHA is an insured mortgage by the government, which will have upfront mortgage insurance premium, monthly mortgage insurance premium, but it has the lowest down payment out of the three programs. 3.5% is your minimal down. Conventional is based on more of a credit-worthy borrower, where you're going to have a higher credit score borrower, a little bit more money in the bank. He's going to have slightly a higher interest rate because these loans aren't guaranteed. But it's a larger down payment. It's more or less set up for your 20% down borrower. Granted, you can do them with 5% down. It's more set up for your higher credit score, higher money borrowers. VA is strictly for veterans, currently active and or retired, and you can get 100% financing on VA loans, and it's also backed by the government, and it does not have an upfront, or it has a one-time upfront mortgage insurance premium charge and no monthly on VA.